Hello, Quasar Markets Live. You love him, you know it because why? Because options, options, options. Everybody loves options, and this is a good one today. Dr. Ellman, this is an exciting one for me because I think the whole world likes short-dated options that they just can't help themselves in this world. And you're pulling it up for how to generalize annualized returns. So I'm excited about this. I'm going to leave you right to it. Have fun.
Okay, well, Steve, yes. One of the biggest mistakes that retail investors make when they're selecting their option trades, and I'm on the sell side of options, is they go for the dollar amount, the largest dollar amount, and they feel they're making the most money. So, one of the things that you and I have talked about, Steve, over the last 3 years is the fact that when comparing security to security, a lot of times retail investors will select high implied volatility securities because the higher the implied volatility, the greater the premium. So that's when you're comparing security to security, stock to stock, ETF to ETF. So when you're selecting the highest implied volatility security, you do get the highest premiums, but you're also incurring the greatest risk to the downside. So that's one mistake. But the one we're going to talk about today, Steve, is the one related to the same stock, same strike, but different expiration dates. And I could tell you from firsthand knowledge, because I have been very fortunate over the last almost 20 years now, speaking with so many covered call writers and cash secured put sellers, that they will go for the highest dollar amount, thinking they're making the most money. And they don't incorporate into their decisions the time frames. So in today's discussion, Steve, we're going to talk about shorter dated options and the fact that they do generate the highest annualized returns. And I'm going to be using a real life example with one of my favorite securities, Invesco QQQ Trust, which is listed on the NASDAQ exchange under the ticker QQQ. Okay, let's move on, Steve, to the next slide. And I'll give you an overview of how this discussion will play out as it relates. In this particular case, I'm going to talk about cash secured puts, but the very, very same principles also applies to covered call writing. So large dollar premiums can be very enticing, particularly for retail investors just starting out with options. So you see a $17 premium for the same stock and the same strike. And you would say, is that better than an $11 premium? How about a $20 premium? Is that better than a $17 premium? Not even thinking about expiration dates, just the premium dollar amount. Well, before you say yes, of course, don't forget to factor in that time to expiration. And that will have a huge impact on the annualized returns. When you annualize these returns, then you will be comparing apples to apples. So what I'm going to show you in this discussion is that shorter dated options generally, almost always, have the highest annualized returns. And once again, we're going to be using the triple Qs to make this point. Okay, let's move on. So for those of you not familiar with Invesco QQQ Trust, this is a passively managed exchange traded fund, ETF. That means it includes a basket of stocks. It's not just one stock, and it tracks the NASDAQ 100 index. So when you have one share of the triple Qs, you actually have part ownership in 100 of the largest non-financial companies listed on the NASDAQ exchange. And as you'll see in just a moment, it is very, very heavily technology related. So let's actually show you now the top 10 holdings currently in this month of February 2026. In the next slide, Steve, we're going to show Quasar viewers the top 10 holdings currently. And you could see here, we're talking about big time, for the most part, technology based companies. Right now, the top three are NVIDIA, Apple, and Microsoft. But then you also see Amazon, Meta, Tesla, Walmart, and Broadcom. So you're talking about the real big boys. So as I mentioned earlier, over the last 30 years I've been trading options, this is the security that I've made the most money on. Now, it's not always in favor. Like right now, technology is a little bit down, so I may not be using it today. But over the long haul, this is the one security. If somebody always asks me, "What is your favorite security?" I don't know that I have a favorite one, but this is the one that I've been the most successful over the longest period of time. You have to make sure, though, that technology is favored by the institutional investors at that point in time. So this gives you a flavor of what the exchange traded fund, the triple Qs, is all about. All right, in the next slide, Steve, we're going to now start with a real life example with the Qs. And I made this slide on February 6th, a couple of weeks ago. And at the time, the Qs were trading at 602.28. Now, when I sell a cash secured put, I always sell an out of the money put at a lower price than it's currently trading for. That means I'm agreeing to buy it at a lower price than current market value. That's what out of the money cash secured puts means. So on that day, 2/6, once again, the Q's trading at 602.28. We're going to look at the 590 put strike in three different time frames. First, 313, then 417, then 515. So on the 313 expiration, again on 2/6, so it's about 5 weeks out, that had a bid price of $11.71 a share. That means for every contract we sell, we're going to generate into our cash account $1,171 per contract. For the 417 expiration, 1710, $1,710 per contract. And finally, for the 515, same strike, 590, the bid price was 2067 or $2,067 per contract. So a retail investor will say, particularly one just starting out, well, obviously these are listed worst to best, but is that really the case? And you know already the answer is going to be no. Already told you that. Okay, so let's move on now, Steve, and actually run these calculations using the BCI trade management calculator, which I pretty much show you, Steve, at every single time that I've spoken to the Quasar viewers, because this is the spreadsheet I use 100% of the time when I'm doing covered call writing and selling cash secured puts. So starting on the top in the blue cells, you could see I listed the 602.28 is the current market value, the same strike 590 for all three expiration dates, and then the different premiums I alluded to before, 1171, 1710, and 2067. Now, Steve, let's look at the bottom now. In the red oval are the number of days to expiration. So obviously, 36 days would be the shortest dated option, 313, 36 days, and the other two were 71 and 99. Now, the way Excel spreadsheets work, to annualize something, they'll take the return, divide it by the number of days in the trade, and then multiply by 365. This particular spreadsheet will do that exact type of calculation. Okay, now the yellow field in this particular screenshot will show you the break-even price points, which is the strike price minus the premium. So 590 minus the three different premiums, and that will give you the break-even price points. Now, if you take a look in the brown field, that's the key now. In the brown field, you will get your initial return. So you'll notice that the returns on the shorter dated to the longer dated options are 202, 298, and 363, right? So the return gets higher as you go longer dated. But again, that's over a longer time frame. So we didn't yet annualize it. And if you take a look now in the pink field, now you get your answer, ladies and gentlemen. Those are the annualized returns. So shortest to longer dated options are, in the pink field, 20.53, 15.34, and 13.39. So the shorter dated options have the greatest annualized returns. Consider that pink field comparing apples to apples, right? In the brown field, where it's the reverse, the greatest return is the longest dated option, that you're not comparing apples to apples because those have different expiration dates. And so when you want to figure out where do I have the potential to make the greatest amount of returns, the answer is shorter dated options. And now, if you just one last thing, which isn't really part of this discussion, but I want to mention it anyway, is the purchase discount. So if the price of the Qs drops below any of those, the 590 strike at expiration, we will purchase that particular security at the break-even price point, and you could see the greatest discount is for the longer dated options. But once again, that's over a longer time frame. So you could run these types of calculations for pretty much any security. And I never like to say anything is 100%, but pretty close to it. You're going to see that generally speaking, shorter dated options will give you the best long-term returns. And in order to quantify it and compare apples to apples, we do it by annualizing the returns. So in the last slide, Steve, we'll just kind of summarize everything. And that is, when we evaluate our option returns, when we are crafting our trades and deciding what time frame to use, what security to use, and what our returns are going to be, we could look at the dollar amount, but we must factor in time to expiration. And the best way to do it, in my humble opinion, is to annualize those returns. And once again, Excel spreadsheets will do that for us. And we have the data in the trade management calculator that will do that for us. And in that case, we're able to compare everything on an equal footing. And so that will help us make our determination as to what strikes we're going to use, what expiration dates we're going to use. And this comes after selecting the underlying security. As I said, the triple Qs is something I've used probably more than any other security over the last 30 years, but it's not always in favor, and I don't always use it. But I would say that's the one that's made me the most money by far since I started selling options back in the mid 90s. And once again, a great spreadsheet, in my humble opinion, I'm unbiased, is the trade management calculator, something that my team and I developed about 3 or 4 years ago.
So, yeah, and I'm gonna do this right now, Alan, for you. I'm gonna show everybody how to get a hold of you too, as well. The Blue Collar Investor right here. This is their awesome website. Check it out. Click on the link here. I'll pull it up for everybody here so you can get a good chance. I see a lot of people looking now, trying to find the link. I'm gonna go to you guys right now. Click on this. Reach out to Alan. He will definitely reach back out to you. He will definitely talk to you. He has been doing this a very long time, since the 90s, like myself. And look, when I look at the markets and I look at options, 90 times, I mean, you tell me, Alan, most people don't really understand options. They think it's one-sided. You buy, make it, put some calls, and that's it, right?
Well, I think a lot of people consider options too risky. And what they need to understand is that there's a whole range. And you could do very risky options, or you could come to my world and do low-risk options. And as I always say, Steve, these strategies are low-risk strategies. What they aren't is no-risk strategies. So you have to understand what the risk is and then how to manage the risk. That's a whole nother component to selling options, and something I'm sure we'll be talking about in the weeks to come. But once you know how to enter a trade, you know what stock or ETF you want to use, you determine your strike price. We alluded to that in today's discussion. And then you enter the trade, but you also have to be prepared to manage those trades. And that's also something that we teach in detail.
Yeah, and I'm going to give you guys all of the contacts for Alan as well. So bear with me as I put the banner in there for you. You'll see it at the bottom. If I can give you Alan's, there we go. Give you Alan's email address. I know he will definitely reach back out to you. Reach out, talk to him. He will. There you go. Alan at thebluecollarinvestor.com. He will try get. I mean, look at the website. It's awesome. It's giving you actually a free introductory training session, so you won't feel it. And as you know, from my side of it, things, I always say options aren't scary. You just got to learn them, right? What the basics are, and then as you learn these strategies, you'll be able to do it yourself. Alan at the Blue Collar Investor. Alan, my friend, and I know him personally. Listen, folks, Alan's a good guy. Not only that, but he's giving back to you 40 years of knowledge. So there it is, folks. Alan Ellman telling you exactly how to make strategies out of options, and I love that. Alan, I'll see you right back here next week, my man.
Thanks, Steve. Take care.